The war on crypto is heating up, and there's been some pretty significant news over the last 24 to 48 hours. I do want to say here before I jump into this video, I've been seeing a lot of the comments saying that my video about getting coins off exchanges was pure FUD and all this stuff. Look, everyone said that it was FUD when people were saying that Luna UST would collapse, when people were saying that Celsius would not allow you to withdraw, or that centralized lenders would effectively trap your funds. And guess what? Absolutely every single one of those FUD scenarios manifested. So you want to call people FUDders, you want to pretend like there's not this terrible possible outcome with leaving your coins on exchanges. Go ahead, bury your head in the sand. I don't care. It's not my coins. It'll be your coins that you lose. So I'm going to keep making the content that I believe in and issuing warnings around the topics that I believe are very important to issue warnings around. And if you can't handle that and it's too emotional for you to hear potential bad news and potential red flags on certain products, then go ahead, just ignore it and do you. But I'm going to continue making these pieces of content because it's really important. And imagine if someone had told you to pull all your funds out of Luna right before the collapse, or out of Celsius before they stopped withdrawals. You would have been very, very happy, even though some people would have said you're fudding. So a little note on that. Secondly, right now we're seeing a regulatory uptick, just like I'm not the only one. It was pretty obvious that after Luna that we'd see some massive regulatory news come out, because of course, these are the types of events that effectively crush retail, even though they also crushed institutions, as we've seen with Three Arrows Capital and their complete dissolution, their complete unraveling, as well as Celsius. We're seeing that it was also the big boys that got crushed, as well as the minnows, sorry. So what we know now is that we're seeing some massive news out of Europe. They've just passed a new rule about KYC AML. It's going to be like a year and a half before this goes into effect, but they're going to effectively make you collect so much information on counterparties, their address, the purpose of funds. All of these things are going to be part of the withdrawal process from exchanges, centralized exchanges, as we're seeing with Coinbase, most likely other exchanges across the United States. And now we're seeing that everyone defined as a crypto asset service provider, or CASP, is going to be required to collect this information on their users and counterparties to send crypto around. Now, we did get a huge win here, which is that NFTs are not considered as part of this bill. So that is amazing. That is something that I was predicting, which is once again that NFTs are sitting in a much more difficult regulatory framework because of their lack of fungibility. The non-fungibility is in many ways a feature. And so this is a really, really important piece of information here. So what we know for sure is that we're seeing a massive wave of regulation come to crypto. And what we hope is that over the coming 18 months, this bill can be molded such that it brings more investor confidence and hopefully less fraud. But the reality is that KYC AML policies are horribly, horribly misplaced. This type of crypto enforcement, which is effectively trying to create databases of addresses of crypto holders, just sets up honeypots for hackers and creates a ton more physical and literal risk for crypto holders. So it's actually a horrible piece of legislation, but they use, the buzzwords such as, terrorism and stuff like that to justify passing these draconian pieces of legislation. But it is important to realize that with more legislation, with more regulation, eventually we get more bullishness. With a regulated market, of course, we will see more capital inflows. That's the reality. It's just about hoping and praying that we get the wins we need to make sure that this industry can continue to flourish. There was always going to be bad pieces of legislation and better pieces of legislation. And our goal as an industry is to hopefully elect and to support the leaders who are pushing sensible legislation that will bring in more capital. But on to the more interesting stuff here, which is there's a lawsuit now between the SEC and Grayscale Bitcoin Trust, spearheaded by Barry Silbert. So what we know now is that Grayscale has been trying to convert their Grayscale Bitcoin Trust into an ETF now for several months, if not a year plus, and that they've now decided, after being rejected, that they're going to sue the SEC. This is effectively one of the first lawsuits I've ever heard of that is between a company and the SEC. And it's really the big boys of Grayscale taking on the regulator on behalf of the entire industry. Remember, Ripple got sued by the SEC. They didn't sue the SEC. So it's important to realize that there is a huge, huge discrepancy here between what we're seeing now and what we've ever seen before. So just know that this could be a landmark moment for crypto. We really don't know what legal standing they're going to be using. There's going to be a ton of news on this over the coming months and probably years. It's probably going to take at least a few years, if not 5 years or so, to settle this legislation. During that time, you'd imagine that an ETF will be approved. So in my opinion, this maybe forces the conversation to move a little bit faster with regards to a Bitcoin ETF, but it's just a very, very interesting piece of legislation. What we know now is that we're going to start seeing legislation come, but it's important to realize that during this entire collapse, what we saw with Celsius, Luna, and all of these other players was that effectively DeFi did what it said it was going to do. The code ran perfectly, even though the reality is that the expectations for APYs and returns were shattered into pieces. The real failures across the crypto ecosystem that we must maintain an understanding of is that leveraged centralized players went bust, and that credit, when it's issued on reputation, is one of the biggest issues in crypto. What we saw and what we now know is that Three Arrows Capital was issued a ton of credit, was lent a ton of money by huge parties within the crypto ecosystem based on their reputation. Suzu and Kyle Davies had an amazing reputation. Again, it's not an endorsement of him as a person, but he's been putting out amazing articles. Check out Arthur Hayes' recent article called The Number 3 or something like that. He just put it out, and it goes over effectively how Suzu and Kyle Davies created this mystique and allure around their ability to generate profits, but really what they were doing was just sticking tons and tons of borrowed money into Luna and then arbing it out and effectively paying their borrowers 10% and making 20%. So they were making a spread there, and they did it with billions of dollars. So what they did was effectively gain credit without collateral because they were so trusted. Now you can't do that in DeFi. In DeFi, the code specifies you need to put up a certain amount of collateral to have a certain amount of loaned capital. And that's why DeFi, even though everything was falling around, the code kept executing. There was no pausing of withdrawals on Aave or Compound or any of these services because the code was the dictator of what amount of money was lent and why. So in many ways, DeFi has still held up in some senses from a code standpoint. And the promise of having, non-human based credit is very, very interesting. And it shows that that form of credit actually performed as designed. Whereas the human form of credit with the centralized counterparties, the way apparently Celsius was doing their books. And again, I want to return back to this because I saw some people commenting in the comments that I'm just parroting what Sam Bankman-Fried has been saying because I have an FTX sponsorship on the educational series. The reality is that if you guys don't believe that Sam is seeing the books of all of these companies, then you're living in a fantasy world. FTX just bailed out BlockFi for a $250 million deal. It was really $25 million plus their liabilities. So anyway, the point is they had a fire sale because BlockFi was valued last year at $5 billion. So what happened was BlockFi lent Three Arrows Capital a ton of money based on their reputation and then got totally slaughtered when Three Arrows and their sort of arbitrage game came crumbling down because of Luna. So what do we know is that the human capital error, the human aspect of DeFi was really the fatal flaw. It wasn't actually the DeFi protocols themselves, and that this innovation of DeFi still holds a ton of water. So I encourage you to read that piece. It's extremely well written. But the takeaway here is that what the death knell for Three Arrows Capital was that they built up so much borrowed money based on their reputation and not based on collateral. We can't do that, and that is something that created a ton of systemic risk. The reality is that every single one of these companies, Three Arrows included, went to Sam, went to CZ, and went to the biggest money bags in the industry for bailouts. And you better believe that Sam and FTX know exactly what the balance sheets are of many of these insolvent companies. So this isn't speculation. Everyone is going to Sam if they're having problems. And so it's not speculation on his behalf, and it's not FUD. He actually knows. He's seen the balance sheets. He knows how bad this is. So if you guys don't believe that, again, live in your own fantasy worlds. Please do it. Stick your heads in the sand. But we're going to live in the realities right now and react to the facts of the now. If you guys enjoy that, smash that like button because we're going to try to bring you the most up-to-date information, helping you get ahead and stay ahead. Even when people were looking at certain numbers as buying opportunities, it's important to read the room and understand that patience has been the only play to make since really the crash began. Fungible tokens are going to be in an entirely different regulatory regime soon, whereas non-fungible tokens are still going to be in their own sandbox, probably developing, in my opinion, at a more interesting pace, and they will probably decouple in some ways the altcoin fungible market and the non-fungible markets. Very interesting stuff. We're going to be doing a lot more deep dives. Again, I wasn't planning on making videos out here when I'm in the hut, but so much is going on here that I needed to keep this channel up to date, and it's just far too nuanced for Twitter. I haven't been able to publish enough to Twitter because these updates are too nuanced. There's too much going on, and it needs more explanation than a tweet thread. So really what we need to recap here is that there is quite a bit of regulatory pressure ramping up on crypto, as predicted. That on the whole, once regulation gets well formed, it will bring in more capital into crypto. That's a good thing. It's more bullish. The narrative around Bitcoin as decentralized sovereign money, again, while there's these liquidity crises, while the Fed is deciding to beat the heck out of all markets, which won't go on forever, but it'll go on until they control inflation. This is a cycle, a money cycle that we haven't seen take place in decades. And it's something that we need to be respectful of, like I've been saying, and we need to monitor. However, none of the macro bottom signals have truly gone off yet. And that's why I'm patiently waiting. You can start DCAing in if you want. I don't think there's any problem with buying Bitcoin and Ethereum at these levels. Not your whole buy, but starting to nibble. Again, I think that we do see lower lows in the future, and that's why I'm holding out a little bit and just sort of seeing the direction of the macroeconomic storm. Remember, we have earnings season coming up. That is going to be the first earnings season recession that we've seen, because there's ain't no way that these companies are posting profits right now on the level that they were predicting. So we're going to see downgrades from earnings season. We're also going to see the housing market get hit very hard over the next few months as the new house listings have been skyrocketing. I saw a piece of data from Redfin. I believe that they're doing the best, releasing the best information on the housing market right now, and it is absolutely brutal what is happening to housing. Of course, rising interest rates means that the monthly payments for new housing buyers have gone up, literally doubled, and the housing market has certainly not cut housing prices in half to match that new monthly payment. So it's really important to realize that these interest rates are going to cause a dramatic downturn in housing valuations, which will have a knock-on effect, right? So we have several macroeconomic factors still brewing. Again, the optimistic view here is that in September, late August, September, we could see inflation come down meaningfully. We could see that there's enough damage done, and maybe we could see a small dovish pivot from the Fed. But until we start seeing some kind of change out of the rhetoric of the Fed trying to truly beat the heck out of these markets, it's hard to see the monetary cycle pivoting towards the risk assets. That said, I want to be very clear. None of this matters for the product cycle and for the actual development of the applications around the blockchain. And in my opinion, all of these problems in DeFi and CeFi put even more of a spotlight on gaming. It's been my belief that gaming, because when you think about it, everyone's chasing yield in DeFi, but where does the yield come from if there's no product where people are spending money at the core of the ecosystem? Games are the reason why I loved games and have continued to love games as a key use case for blockchain is that there's a real product at scale, billions of people spending billions of dollars, tens of billions, hundreds of billions every single year. I think it's actually close to 200 billion on gaming globally. And they're buying digital stuff, digital experiences, digital characters, and they're buying them because they like that stuff for the value it provides, the intrinsic value. So that's the difference, is that there could be actual profit centers at the core of these gaming protocols, which makes it very different than DeFi, which is really just a lot of, at this point was a lot of smoke and mirrors based on increasing asset valuations. So what we see now, in my opinion, is an even more bull case for gaming, although in this market, no tokens are going to go up. No token will be spared in this market. But if you take a step back, in my opinion, it clears a path for NFTs in gaming. The reality is that the product cycles, even in economic downturns, continue. Looking at 2008, there's a great thread by Chris Dixon over at A16Z. And he talks about how the golden era for development for the iOS store, the golden era that brought us Snapchat, Uber, Venmo, and more, Instagram, all of those products were created between 2009 and 2011. or 2008 and 2011 in the App Store. And that was the golden era. If you remember, that was also the great financial crisis. So understanding that the product development cycle and the economic or monetary cycles exist completely independently is really important, and that we could be getting, and I believe we will be getting, the actual killer applications of blockchain. I believe that they'll come in the form of games and other NFT-based products and ecosystems. And I believe that that is the trend that we need to be focusing on with an absolute eagle eye over the next few years. I also see a lot of really interesting trends in the creator economy and social media. Those are really important areas where social media and blockchain and NFTs add a ton of value, real value that people will pay for today and are paying for today. And so it's important to look at the economies of scale in the digital world and how they can apply to the blockchain outside of just decentralized money. That's where I see the world going. And I do believe that the golden age of crypto development products, of crypto dApps, if you will, is going to be upon us over the next few years. Meanwhile, token valuations might be depressed. And so this is really the opportunity, is to understand where the value is being created, even if the market doesn't reflect those valuations due to decisions that are way outside of crypto, like the Fed, regulatory pressures, and things like that. So again, the opportunity, in my opinion, is opening up like crazy. The more bearish and the more scary it gets, the more we're at the part of the cycle where it's embarrassing to talk about being in crypto. Crypto's a meme. We've seen it happen where people are starting to feel where they once felt very proud to be a part of crypto and they felt like they were a genius. They're now feeling embarrassed. They're feeling the shame. This is exactly the way it was in 2018. And meanwhile, some of the biggest products and some of the biggest projects of the most recent bull run were forged in 2018 and 2019 bull runs. So keep your eyes out. Again, you don't need to take risk to stay engaged. Staying engaged, in my opinion, is one of the most important factors in the future success of crypto and staying engaged through the bear market. If you guys are enjoying these updates, you enjoy these takes and you're getting value out of them, smash that like button and remember to subscribe, because we're going to be bringing you as many updates as possible. I appreciate you all sticking with us through the bear. And again, keep your head screwed on right, because it's not FUD if it's true. It's not FUD if it's based on fact. And I'm trying to help this audience hopefully avoid more punishing losses. If you have your coins on third-tier exchanges, that's a huge risk that I would hope, personally, that you don't take. As always, I'm Elio Trades. You can find me on Twitter at Elio Trades, and I'll see you very soon on the next episode.